All right, welcome to If Prices Could Talk. We are doing a rundown of pricing in the news headlines today. So I'm here with Jeet, Pete, and Adnan. We're going to go through mostly B2C examples of things that are pricing related and talk about implications for B2B commercial teams, either in the price setting or the price getting frames. Let's start with shrinkflation. So this article was in The Hustle. Let me read the headline. The headline was Why Toilet Paper Keeps Getting Smaller and Smaller. This journalist went through like a deep dive about the size of toilet paper rolls over the years. And this was like in how he phrased it, like the most egregious example of shrinkflation that he could find. You had like 650 sheets of toilet paper back in the 70s. And then if you compare to a toilet paper roll today, which the example he had was 56 sheets.
One of the first thoughts that came to my mind is like, well, if they're pushing this out there, how does that impact their cost structure, particularly at the cost per unit, right? Because you sell larger items, presumably because there's economies of scale, and for the larger mechanisms of toilet paper, you're likely saving a little bit on the cost per unit, and it becomes reasonable. But it does feel like toilet paper is one of those things where it's just really, really hard when you're purchasing to figure out what a normalized cost actually is, right? Because of the packaging and the positioning. But then the article just got really, really interesting because they're in essence using this as a way to protect themselves from the cost of volatility, meaning like that soft pulp versus the harder pulp and how that price changes over time. So this was basically a way to command a little bit more from the market as a result of these kind of variable costs that I myself had no idea about. But I think what's standing out about this article is just, to your point, how egregious Charmin is about that and kind of that mix of ingredients and the extent to which they claim they are protecting themselves against cost volatility. But what it seems to point to is that, this is just it. Part of it is cost, but I think the bigger driver is really a mechanism to get profit.
He was like deep down the rabbit hole of wood pulp indices.
Yeah.
Yeah, the other interesting thing I thought in the article was actually the competitors about like bamboo-based products, which are more eco-friendly, but also on a cost basis, potentially cheaper, but they don't have the marketing power to kind of take it over. But I think it will be one of, like we've talked about this before, like Jeet's example of like the Plaque and Wendy's positioning them as kind of a leader in sustainability long before any consumers make a decision on where they're going to go purchase at the time. So in some ways there could be an opportunity for those kind of bamboo companies to stay there and then get market share over time, particularly if their cost inputs are more stable and consistent, and then the different pulps for paper and packaging kind of fluctuate up and down pretty widely, at least in the past 10 years of data that the article showed.
This is also one of those things. It's a vertical, right? It's kind of like everybody's following the same strategy. So if everybody's following the same strategy, and you think there is a gap, there's a market need to quadruple the size of the toilet paper, and you're going to get all the market share, this guy should just start a toilet paper company and do it. If he thinks it's that easy, that it's shrinkflation and everybody's out to get him, and he needs to come up with a new business and do it. My thing is, first of all, I think he used the wrong metric. I don't think we should use number of sheets as a metric for shrinkflation here. It's going to sound gross, but you should really look at how much toilet paper you use for your household of four or six or three or two or one, and say, has my consumption changed? Am I using more now? Am I overall, my budget for my toilet paper, is it up or down relative to last 10 years? I think that's a better metric to use than number of sheets, because all these players are going to say the way I put my paper together is differentiated. Therefore, you're going to be using less. Therefore, your total cost of use is actually going to be down. So that's the first thing. So
like index adjusted, inflation adjusted
right.
use per person per month or
Right.
something like that.
I think it's ridiculous. So
Yeah.
the metric itself, the whole entire paper falls apart because he's using the wrong metric to gauge or make this conclusion. So his conclusion's wrong. Second, I think that there is an opportunity here, and Pete, I think you pointed to it, which is, or Adnan, you said it first, which is the cost fluctuation. I think the cost fluctuation is going to dictate how these paper towel companies, not just bathroom paper towels, but also just regular paper towels, napkins, and everything like that. I think there is going to be some innovation that's going to be put in there. And that innovation is going to be dictated by the huge swings in cost, as well as the sustainability piece that Pete, you brought up. I think both of those is going to come to a head. I've been getting sort of push notification on, non-paper based toilet paper. It's like synthetically made toilet paper. And it's like $20 a roll or something like that. It's ridiculously priced right now, but you could tell the dam is kind of breaking a little bit for new innovation to come in because of those two major points. I think we live in a free market. We should be able to price and package things. If there is a gap in opportunity, if Charmin is egregious in the way that they're producing shrinkflation, in the way they price, there is literally 60 other options that when you go to Walmart, you go to Costco, you can see on the shelves. Go pick something else. But if everybody is doing it and consumers don't have a choice and they're truly gouging the consumer, I get your issue. But over here, he also didn't include all the cost to acquire customers. He didn't put in there how much marketing costs. He didn't put in there what the cost of competitive positioning is, because it is one of the most competitive markets you can go into.
All right, we'll see what's happening in the next couple of years with that.
Wound up this morning, I just realized.
We had to start with one that we knew would take us off the rails a little bit, because that's just kind of how it goes. All right, the next headline. So this was actually a former Nike exec who wrote a piece that went crazy viral on LinkedIn. The headline is Nike, an epic saga of value destruction. The piece started with, he walks through like the Q2 results were so bad relatively in 2024. How did they lose so much market share? So he walks back towards like the new CEO, stepped into the role in 2020, and like three main things that he was focusing on. So I'm just going to say what those are for context, the people that don't know the article, and then we'll jump into it. So his three things. One was that Nike would eliminate categories from the organization. So brand, product development, and sales for it's kind of like lost expertise from his perspective for running football, things like that. The second was to become a direct-to-consumer led company, ending wholesale leadership. And the third was that Nike would change its marketing model, centralizing it and making it data-driven and digitally led. So those three pillars of the new CEO's vision from 2020, he kind of like ties it all back to their falling market share from the last couple of years. So let's start more broadly. What were your takeaways on this one?
It sort of reminded me, 6 years ago, there was a lot of bad press with Nike going after Amazon for resellers who were kind of selling their product in a non-branded Nike store. They only had not on the Nike store, basically. So they were just trying to really tamp down on that. I think that was in line with just the DTC strategy that they're pursuing right now, and really pushing away from any wholesale retail channel, just making sure they controlled it as much as possible. And I think Nike Town's another example of that, where, I remember, 25 years ago going to Nike Town, and it was like this experience. It was the branding, it felt like tech forward, all that sort of thing. And now I don't even know how many Nike Towns there still are, but it sort of feels like almost a TJ Maxx, or like a little bit more decrepit of an experience. It's like not as cool as it once was. And so I think they try to control so many things. And just like from my consumer standpoint, you can see just the decline. I think the brand of Nike, as far as winning and elite athletics, is probably still very strong, but as far as like how they reach people, I think there's just more competitors that are pursuing more strategies, both retail and DTC. And by trying to be so narrow, they've probably boxed themselves in a little bit.
From my perspective, the new CEO made a fundamental error in understanding what Nike's brand is. I think you put in a non-brand person in that role, where Nike was selling experience. Their advertisements, everything wasn't about their shoe. It was about women. It was about people running late night. It's about, winning. It's about all these different experiences, different types of people having different experiences in different sports. It's that feeling, that euphoric feeling of winning, of succeeding, of competing, even just competing. And all of that went to garbage with these strategies, because I think these strategies is employed by people that are looking at mathematically what could be accomplished instead of understanding what the brand is and understanding how consumers make their decision. So the consumer purchase decision was not taken into account at all by the CEO and by the directives that he put in place. And the reason I say this is because products like Nike is something that's purchased not just because you have a need. Of course, when you have a need, you go research, you buy something. But Nike is also, you wander the stores. And Costco has this number that's out there that says, I'm going to get the exact numbers wrong, but for every 1 minute you wander, your customers wander the floor, they make an extra $1.37 in revenue. So there's a direct correlation to people wandering through stores and your revenue going up, because that's the power of consumer-based pricing, right? There's that emotional piece that's there. It's not just need-based. It's not just I have to have something, I'm going to research and I'm going to go buy something. It's not that direct. So they lost by not utilizing the hub and spoke sort of universe of wholesalers, retailers, and all this stuff, and their leadership position. So you're giving up the best spot in where how your shoes are displayed. Now Puma's up there, now Reebok's up there, now other people are up there, and people are walking around going, I can't find my Nikes. And I not need, I feel like buying something. Oh, these Pumas are really nice. I'm going to buy this Puma instead. They feel good. So all of a sudden, lifelong Nike brands are like, people are changing brands because they're not part of the option set that's out there when they go wandering these stores. And by the way, we did a podcast before, Tracy, about I think it was Netflix and others creating these experiential centers for people to go walking around in, right? That's like taking the brand from, I do this, but I'm going to give you an experience that's extrapolated to all these other things. And Nike just did the opposite. They had built the experience, and now they went to, I'm a SKU, I'm a product, and you're going to buy my product. And that's why they have too much inventory and they get a discount, which crashes their value overall.
That's the thing that was interesting in the way this guy was kind of walking through the problems, was like when you shift everything, like they cut off a lot of partnerships and things that were like kind of very spread out, like around the world, focused everything on Nike.com. And then you have people in this frame, like when you're shopping online, where you're looking for discounts and the sales and all that kind of stuff. And you're stuck in a pricing frame when everything's focused on the website. So you've got like that in the mix, but overall, he was saying kind of thematically, they moved from brand marketing to sales activation, and they just lost a lot of the soul of, like, I was thinking about remember the old Nike ads, some of those most iconic ones of like, kids running really slowly. And then their whole thing was like, if you have a body, you're an athlete. And there was a lot of like emotional, inspirational stuff. And they cut away a lot of that brand communication investment to focus on data.
Yeah, I 100% agree. I mean, the brand of Nike is just so incredibly important to the company, and that's true for the consumer fashion industry in general. So I found the article fascinating because you start to think back to the origins of Nike, and I don't know, for those who might have read the Phil Knight book, Shoe Dog, what they get into is the fact that when Nike grew up, right, they grew up by creating a differentiated product, right? A running shoe that was truly made for runners that they can connect to. So that was part of it. But then the other part of it that they found really important and had pinned their success on for a long time was the connection with athletes. So they got Steve Prefontaine, who was like an Olympic level runner. He was kind of that first connection. Then obviously, they'd built up through the 80s and 90s via athletes, whether that's in the NBA or other sports. And that came about, and that was just such an important part of their brand, but they were also, and that helped them maintain that level of differentiation with the product itself. So not only were the shoes quality, but you had this, people had this emotional connection with both athletes, what they could personally accomplish as a result of wearing these shoes. And then it felt like it just kind of, what the article pointed out was there was this kind of shift from building up and maintaining the brand itself to, say, the channel in which they're taking it to market. And that just seemed to really backfire because they seemed to kind of lose the true essence of what made them successful. So not to say that you shouldn't optimize any type of business, but they seem to neglect the core of what had historically made them successful.
This is such an interesting example of pricing being so much more than just the price point. There's like so many different things that kind of add up to the big picture here. But what do you think about how they're going to recover? I'm sure they will.
I think the brand power is still there, right? The brand power is there. That's the good thing. I think getting athletes on board, getting influencers on board, I think all of those things, are going to help them. The question that I have is, how are they going to get relevance back through distribution? That's, retail distribution and all that. That's the bigger question I have, because now you basically you're coming back begging a little bit, right? Even though you're a big brand, you've got a lot of power. So I'm not suggesting that they're going to be cowering to a retail store, but they did lose a little bit of that magic. They lost a little bit of that power. So that now the distributor, the retailer, can force them to have better costs, better pricing. They can force them to do some of those things that maybe they were getting taken advantage of. So I think to flush this experience out is going to take them a few years to kind of gain back that trust, gain back those cost advantages. Competitors are already in there. I bought a pair of Pumas when I was in New York, and I'm a Nike guy because I couldn't find the one that I really wanted, so I bought these Pumas. So it's like, I think it's going to take them a little while to get that stuff back. But having said that, I think their brand is still fairly strong, so I don't think they'll have a problem doing it.
All right, let's talk about the NFL. So this headline, the impending private equity blitz on NFL teams. So this was marketplace.org. Private equity can now buy up to 10% of a team's total value for the NFL. They need to stay invested for 6 years at least. And it seems like they won't have much direct say over how teams operate. The other thing that I thought was interesting in this article, it says American sports leagues have historically generated a higher rate of return than the S&P 500 in recent years.
I mean, the poor owners, they have all this illiquid cash locked up. These billionaires, they can't even access it. So yeah, let the guys get their PE money, get paid.
Yeah.
It's insane. It's so insane. That was my first thought, Pete. I was like, these guys are just exiting out a little bit. They're cashing out. That's a lot of cash to be held in one place with the valuations going up. So it's just the owner. The NFL is basically, for those of you that don't know, is a collection of owners. So the owners get to decide. So you've got 32 billionaires that decide, hey, all of us can cash out a little bit to these PE firms. The PE firms are like, every dollar I put in there, it's going to be like 10x in a year. So yeah, except for the Browns. Unfortunately, my Browns. All other teams, I'm sure it'll be like 10x for them. The Browns will probably be the last ones to jump on that bandwagon. But yeah, it's just I agree with Pete. It's just a way for them to PE firms. It's smart. It's a way for them to generate cash, and for the owners, it's a way for them to liquid themselves to use the cash. That's it.
I guess from like a operations perspective, like the mark on an NFL team, I know it's estimated all the time, but really you only see what it's worth when you actually transact, right? Yeah. So every 20 years when they sell, this sort of creates a secondary market where in real time, well, whatever, not in real time per se, but anytime that PE shop maybe exits their position or shares it or sells it to someone else, you'll probably see that more. It gives a little bit more real time nature of the ups and downs of the value of the leagues. That could be interesting just from like an analytics or observer perspective.
On that note, Pete, though, they haven't seen a downturn. I mean, NFL valuations have been going pretty steadily up without
for sure
downturn. So the risk of the bottom is just not there. But to your point, I mean, one of the things that I did think of is, imagine all the people that have equity in their house that could be in the millions. Like, do we get the opportunity to sell 10% of our equity? And not a bank loan, not a home equity loan, but literally sell 10% of our house, 20% of our house to private equity firms and cash out and at least get some of that dollars back and use it for other things.
That's interesting. Yeah.
But because that's exactly what's happening, right? It is very interesting to me is how they're calculating the valuation of the NFL. So it's going up. So their calculation of their valuation and it's because investment is a prediction of future, right? So they're assuming it's going to keep going up, which means consumer spending on things that are NFL related is going to keep going up, which also means they're making an assumption that you're going to get new fans coming in. So new fans means, the US market is fairly tapped out. So they're expecting an expansion into South America. They're seeing an expansion into Europe. They're betting on some of those expansion and some of those demand coming in also. So there's that other side to it, which is the pure valuation and the increase that they're predicting in the future, that this train is going to go on for a while.
I think the other piece that comes into play there is that, they've gone up pretty significantly, and then assuming that they continue to go up, this partially gets back to Pete's comment, but the number of people that could actually buy into an NFL team quickly diminishes, right? So then if you assume that they're going to continue to go up at a similar pace, meaning faster, outpacing the market, et cetera, the number of buyers out there decreases, which could make that transaction a little bit more difficult. So might not be a bad idea purely from a financial perspective to cash out a little bit and get some liquidity into the market. And I think the folks that are buying in will be itching to do so.
All right, we'll see what happens with Swiftonomics too, with everything with Taylor's young fan base and everything. Look, we'll see. One more headline here. This was Zillion's CEO who wrote a piece on retailcustomerexperience.com. The headline is "What Walmart's Pricing Changes Mean for the Enterprise." So Walmart announced plans to equip 2,300 stores with digital shelf labels by 2026. They denied that it would be used for dynamic pricing, which people collapse with the Wendy's fiasco about surge pricing. So do we just talk high level about this? Like, what are the benefits of Walmart doing this and making these changes in the stores?
I guess that in our framework of, value is cost reduction, it is revenue increase for your customers, it's risk mitigation. Think about the cost decrease of just practically, need fewer hours and people walking around changing price tags.
Yeah.
And then on the revenue upside, for something that is a hot seller that you're about to be out of, or is like, rather than having empty shelves, maybe you can raise the price from a central office that sees that happening faster than you would have been able to do that before. So those are just two changes. And then I think we also, to the point about prior podcasts, I think at the same time of the Wendy's dynamic pricing, we talked a little bit about supermarket dynamic pricing at that point. So I think it would be important to the degree that they are changing prices intraday or more than once a week to kind of position it like if they're going to do a happy hour, make it a discount, don't position it as like a price hike during the dinner rush or after school or whatever it is.
One of the things that stood out was focus on the ability to adapt to change, right? And when we talk to clients, that's one of the things that we find to be important, meaning that if your costs are changing, for example, being able to adapt to those types of changes relatively fast is a positive in terms of price realization. I think the downside of this is that the perception from the outside, meaning that the other factor that comes into play is that your pricing strategy has to be perceived as fair from customers. Depending on how technology is used, right? You hear things like dynamic pricing, surge pricing from the consumer's perspective, and there tends to be a bit of a negative reaction because consumers feels like they're getting raked over the coals and prices are simply going to increase at random times, like people were saying at dinner time or something like that when there's a rush. So if that perception of fairness is not there, then that could be one of the big risk factors. So the key is really just to implement it in a way that is truly just, perhaps automating what they currently do, just gets them to do it a little bit faster, but they're not kind of, going out there and treating consumers unfairly.
I think it's a great idea. I think it's fantastic. I'm surprised it took them this long to do it. I think almost every grocery store should put it in there. One of the biggest problems we have is things that expire. Just a simple use case that they have to throw away. We have people that go hungry every day. There's a new app. I was just looking at my phone. I think it's called Too Good to Go. In major cities, they have gotten restaurants together to offer great deals towards the latter part of the day or early in the morning, where they're trying to get rid of stuff that is not going to last. So a bagel place might say, hey, come get a dozen bagels that you can freeze and that you can eat over the next week or whatever it is. But you can save those things. So in dynamic pricing, it's fantastic to go, hey, we have extra of bagels or extras of this that's not going to last. I'm going to make it dynamically really cheap in these stores where people can come in and take advantage of it, right? We might even market that out, shoot that out to my email-based database that says, hey, we've got extra of this. We're going to put it on discount. Come get it. There's nothing wrong with that. And by the way, for the other side, that maybe we're running low on something and I'm going to put it up by 25 cents, there isn't a product that's out there that doesn't have a competing product. So if they're doing that with one product and you want to switch to somebody else, go ahead. And by the way, there's also 17 other grocery store within like 1 mile radius. If you don't like the price of what you see, go to another grocery store. Like, it's just the mindset of us not taking advantage of the good side because we're so scared of that one, but water is going to be $2 instead of 55 cents or whatever. I think that mindset is horrible, because this really allows for you to get rid of things at a more consistent way, perishable things in a more consistent way. People get the advantage of pricing. People can feed their kids properly at lower cost because these grocery stores would be able to do that. I think it's a great upside. Yeah.
We'll see what happens. Okay. All right. Let's stop there and we'll pick back up next time. Thank you.
Thank you.
All right.
Thank you.